Hey everyone, we continue our end of year series with the forecast for next year for the market, and the main topic is going to be the bubble popping. To understand the current bubble, we have to talk about the previous bubble, the one in 2000 with the dot-com bubble, and we talk about Cisco. Cisco basically had a huge run-up. It's the Nvidia of the 2000s. And why it went up is because they were selling routers, the building blocks of the internet at that time. And remember, it was not common tech at that time. So because it was not common tech, only a couple of companies, other companies, could benefit from buying a lot of routers and installing them because they had the know-how. So uh, because of the exclusivity aspect of developing the internet, like I said, only a couple of companies could do it. They were the ones benefiting from that. And Cisco went up on the belief that that status quo would remain forever. But it wasn't so, obviously. Like when developing routers became more common, the knowledge spread out to more companies, cost went down significantly on the hardware side, and eventually cost went down significantly on the software. By software I also mean like the labor required to continue expanding the internet. And when that reality kicked in, things went downhill. And we are now at the same point for the AI bubble. uh, I'm assuming you guys also saw this article, or not article, this news from last week, Thursday, Friday, about a Chinese AI startup basically training a LLM model almost at the same level as OpenAI with only 2048 GPUs. Cost in 2 months, it cost them 6 million, and they have like 140 engineers. This compared with the thousands that the big guys have. And this time the bubble is amplified even worse because NVIDIA GPUs are even more exclusive. First of all, you cannot buy this as a no name basically. Uh, Only the big guys can afford them. They cost like 20K a pop, and you need supposedly tens of thousands of them to even train your models. Plus, you need a lot of engineers, and you need like a huge team to get going in the business. So that gives companies that can do this a huge premium. But the Chinese guys not only did this, but they made it public. They made the model open source, and anyone who wants to look at how they did it can do so and learn from it and apply it in their own training. And this is incredible because it takes out the exclusivity from the huge GPU count, the exclusivity from the huge engineering teams, the exclusivity from time, the exclusivity from money, and so on. Basically, any company that is publicly listed can afford 10 million if they wanted to and throw it at this thing and replicate the same outcome. And this is a game changer because it's only the beginning. Just like now a router costs basically nothing compared to what it did 25 years ago when we had the dot-com bubble. The cost of developing LLMs and the amount of resources required, both computationally and the people power required to do so, will go down exponentially from here. This is only the beginning. The real winner of the AI software race is not going to be the cloud guys, it's going to be the first company that develops an LLM you can run on your phone, on your laptop, without the cloud part. Though that company is going to win. But until then, it's just a bubble. And we may be tens of years away from that point. But the cost will keep going down, the exclusivity will no longer be exclusive, and that is going to be what pops the bubble. Because all of these things means an earnings hit. Like if you don't need to buy 50K NVIDIA GPUs and you can only do it with 2K, that's great news for the software guys or for the consumer, quote unquote, because the cost of the LLM can be smaller. Uh, Now, imagine it's not 2000 GPUs, it's only 100. It's not 150 engineers, it's only 50 engineers, and so on. The cost will go lower and lower. And that means less money for NVIDIA and less money for the whole chain of AI, which tries to make money from the hardware side of business. This being said, let's look at SPX on the log chart. This is the same chart I look at every year. This is the log chart of SPX for the full amount is from 1871. And what I like to look at is AVWAPs. The problem is that we don't have volume data for the entire timeline. Like even if I put the AVWAP here for the 1929 crash, it starts from here because we only have volume data starting from the 50s. But what you should take from this is that these long-term AVWAPs always get tested. And sometimes we even go below them. Uh, and right now we are very, very far away from these AVWAPs. Uh, and we don't even need to retest them. Let's say we are at 19K. Uh, by the time we will test this, we will be higher, but we don't even need to test this one from the 50s. Let's just talk about this one from the 74 crash. We can add more like the one from 87 from the 87 crash, which was a support here. We even went below it here. And I guarantee you that at some point in the future, I'm not saying it's going to be next year or even the year after that and so on, but at one point we will retest this AVWAP, which is now, like I said, 19K, but most likely it's going to be like 22K, 25K by the time we retest it, if it's in a couple of years. We shall see. But just even ignoring this, the most recent one that we should be worried about is the one from the 2008 crash, and that's its 2300 basically. And we have a real risk of getting a crash because of the AI bubble popping uh, and retesting this one next year. I think it's not likely. Like I would assume we get more of a topping behavior and then potentially a pullback almost for sure to 55K, like 5K, sorry, not 55. We also have this trend line like this. So the minimum I think we see next year as a drawdown is 5K. And this is basically this trend line here. But this is kind of small. I would expect something more like a pullback, uh, move back to the highs, and then a resumption of the downtrend in which we basically we go back up, and then we go down, and we actually test this trend line at 4K. So minimum is 5K, expected is 4K, worst case scenario is the full retest of this area here, which would be like 25K if we get a crash. To get a crash, it requires a perfect storm of negative outcomes, so this is quite unlikely. And like I said, the chances of getting it next year are relatively small. Maybe we do if the bubble pops for real. For the bubble to pop for real, we need to see earnings fail. If earnings fail, get out of the way. If we see like an Nvidia minus 20% on earnings, we are on our way to crashing because the premium accorded to these companies is absurd. They have to take a 50% cut across the board, like basically FANG, Mega Caps, Max 7. This is not good news for them. They want things to be exclusive. Uh, they want to be in control of all of this. Liberalizing AI is bad outcome for Max 7 but good outcome for the development AI and for everyone else in the world. And this is inevitable. Plus, this is just the beginning, and we're talking software side. There will be competition like crazy on the hardware side. NVIDIA will not have exclusivity on developing AI chips. Everyone else is developing AI chips. Like Amazon is doing it, Microsoft is doing it, Google is doing it, the Chinese are doing it like crazy, and I'm expecting China to catch up in the next 2 or 3 years. So we just had a warning shot with that news on the software side, but the warning shots will keep coming on the hardware side. And once the market realizes this is a problem, it will dump like there's no tomorrow. This is why it's possible to get this kind of drawdown to 2500-ish actually this year. We shall see. This is not this year, the way I do it. It's 2026-ish, 2027-ish even, but it's because of the 3-month chart. So my forecast for this year, let's go to the daily chart. It looks different. Is 5k at a minimum. This could potentially be the Q1 drop. Then we bounce. Let's have a couple of more examples. So let's go to 2008, and this is kind of the textbook drop, retest high, and then begin a downtrend. In 2008, the actual crash was this. I think even yeah, this is when it started. September 9th. No, 27th, something like this. Blah blah blah. Doesn't matter. But this is considered to be the crash. But the market had topped out sooner, and it was in a downtrend ever since September 20 in October 2007. So it took almost a year of a bear market. We were in a bear market for a year because going down. And then even from that low point, we went down and dropped another 30%, 40%. So I expect that we shall see this. This is basically the equivalent of the 5K pullback I think we can get in Q1. Then we go back up, and then we top out for real and begin a downtrend. This is kind of how it happened in 2000s as well. Market is March. Actually, I'll look on Nasdaq and DX like this. So this was the initial drop, had a recovery, still went sideways for a while, and then went downhill. And it actually happened in September. Like it began in September. This second leg down is 9/11. Oh, this leg down. Just this. This is 9/11, and it actually caused us to bottom. So yeah, this is the initial crash, quote unquote. Then we go a bit sideways, and then the party starts. So we can have the same thing. So it's not like a moment where the market starts going down like crazy and instantly drops. If we were to go down, we go down a bit, recover, go sideways for almost an entire year, and then when when reality kicks in that competition is super fierce and margins won't improve and earnings won't improve as much as the market expects them to do, we do these huge leg downs, and uh, then we continue going down for quite a while. So yeah, this is kind of the forecast for the year. So don't expect anything super crazy. Let's go back to the daily chart, and I'll explain why I don't think we can see a major drop immediately, and it has to do with breadth. Like even though breadth improved from what's this advancing declining perspective, the advances were very weak as as gains. Where the fuck is it? This is the advancing declining. So we had this 90 plus devol and then recovered, and we even had 80 plus, we had a 60 and so on. And even though we got a recovery, when we actually look at breadth, meaning this and this, we see we're still very low. And that is because uh, even though the stocks stopped going down, they didn't really go up. Like they mostly went up less than a percent, something like this. So breadth remains really low because this counts the the performance as well. Like if all the stocks go up 10%, this will go up a lot. If they go up 0.5%, it will almost not budge. We still have a setup in which we have to see a recovery in breadth before we actually go down for real. And this is what I am not really concerned about this move that we had on Friday. It could potentially go down a bit more, but not that much. And to show what I mean, let's look at the 2021 top. When we topped out on this as well. Like this was the center rally, and it was a broad-based rally, and we went sideways for a bit, and we went down afterwards. So there's no fucking way we go down more from here. Like the the stocks that went down will kind of resist. They will show relative performance, meaning if the market goes down like 2%, something like on the value list will go down like 1%. Most of the drop will be in mega caps because these actually have a room to drop, but even these don't I don't think we can see a sustained drop from these levels without recovering. So my expectation before the Q1 pullback begins is that we will see a bounce in IWM so that breadth at least goes back to 50% here. And again, when we compare to what we have here, this is what we saw. Like this is the 2021 top. It looks very, very similar to what we have now, and I'll overlap it. Let's do something like this. Let's say like this. Uh, so we need an actual impulsive push in IWM to probably backtest this like to 2300, something like this, to get us the same breadth impulse. Like here, even though the price was lower, we were maxing out as well. Mm. And this is equivalent to the SPY top. Let's put on SPY. So this is what I mean. Like IWM topping out, making a lower high, but a high breadth lower high, so that we have room to drop further. Now this looks kind of like shit. Like even though everything dropped already, the market bounced, but it was only Mag 7. So we don't care what Mag 7 does. They can drop. it doesn't it's not relevant, but the market has to go up from a breadth perspective. Like all the small stocks have to go up for us to go lower, because it's very difficult to have a breakdown from this very low breadth levels. Even if we do, it will be short-lived because we are so oversold from a breadth perspective. It will be something like this, like I don't know, like 20, 2150, but then we will have a huge rally. So before we see the breakdown, I think there is a very high probability that we see a recovery, and only when that recovery peaks out, because it will 100% be a lower high on IWM and most likely on SPY as well, we can actually begin the pullback. So this is kind of what I expect. Even if we go a bit lower, uh, once liquidity recovers a bit, we go into the positive flow situation at the beginning of the year, like probably this week and this week. Even if we go down, I expect we will get a push up, and mm, it's cliche, but the market might top out on inauguration day, like when Trump comes into office. That's when we may see a breakdown. But before that, maybe we see a rally going into inauguration because the market expects big things from Trump. That might not come to fruition because we already seeing problems with the debt ceiling and stuff like that. But who knows? Let's draw this accurately. It will be something like this. So yeah, I don't think we see a breakdown, or even if we see a move lower, the lows will hold. For IWM, that's 2175, or this is US 2000. But we need to see this on a lower high and high breadth. Like this has to go, at least we test this high. Ideally, we go into the red zone here. So uh, while short term, meaning short term is until end of year, meaning today, tomorrow, possibly on Wednesday, not Wednesday, Tuesday as well. Let's just call it end of week. The weakness can persist into end of week, even though it will not be, it will slow down as we near the lows. So let's do US 500. I think at most we can see a low retest. So this should slow down as we near the lows, but this is this is way too much as well. Like I don't think we can drop this much. It's only 2%, but I think it's a lot, and I don't think we can drop this much. So most likely we will, like 5900, we will slow down as we near this. We will consolidate here for a while, and then we have a move up to retest this trend line area. But I would look at US 2000 and IWM as the thing that matters right now. Before we can actually do the Q1 pullback, which potentially has already started because we will make lower highs. But before we see a breakdown, I think we need to see this push up in breadth and get to overbought, and then we can do the next leg down in force. So this is the forecast for the immediate future as well. Um, and that's kind of it. I think we see the top out in yields. This is just reflexivity based on year-end positioning. Maybe we get a final push to 5% on the 20-year, maybe, but I will be buying that. Tomorrow, going all in on yields, and that's kind of it. Dollar is topping out as well. Yeah, nothing really to add. If the market does not break down next year, or basically we do the Q1 pullback, then we go back up. The best opportunity most likely is in Europe, Brazil, China, and that's kind of it. These markets have underperformed relatively, but not Germany. Germany is probably bad, but the rest of Europe should be good. Like France is kind of beat down, and they will figure their shit out. Look at this beautiful consolidation on the French index. Like, uh, even assuming we get a pullback in sync with the US indices after we go up a bit, or we could potentially even break out here, then backtest on the pullback, and then go back up. So France looks pretty good. Oh, this is not the index. My bad. I'm stupid. This is the index. Oh, yeah. This is what I remember. Those were the yields. So that's bad for them. But anyway, going back to here, like imagine uh, France has a breakout, and we're getting to the point where it could happen. Could also see a breakdown, but I think this holds the low. Um, UK doesn't look that good. I had this is Brazil, like retesting this horizontal breakout area. It's super oversold, and if the market is to go higher, the US one, and cover, yields have to top out and dollar has to top out. This will be very good for the rest of the world from both a real economic perspective and from a stock market perspective. So if the dollar tops out, then we see a recovery in the currencies for developing markets. Then this is going to be very good for Brazilian equities. Uh, China as well, like the fact that it held on to most of its gains from this recovery is very bullish. Like if you look at RSI, we have a sideways consolidation and sideways correction. This looks very good. Like imagine this happens. And it's holding up very well. Even if we do a pullback, the pullback should be relatively shallow. We have a bunch of support in this area here, this higher, like this. So basically we broke out and now it's consolidating sideways with RSI curling up and doing a wedge and staying around 50%. Again, even if we were to have a breakdown, that breakdown would be likely a fake one. Do something like this, and then we would be oversold for real, and it would recover. This would only require something like maybe down to here, like 57k on this one, which is still a support area. Very similar to this. See how this we were here, but then we were coming from the up high and we did a breakdown and a full recovery. Then the real one happened, but this one would be sort of like this, and it will play out almost identical to this one, with both outcomes being possible, like down, bounce, and if it gets rejected here, then we do this, but if it's recaptured, we do this as well. So something very similar to what happened here. Uh, yeah, that's kind of it for now. Have a good one. Bye bye.